Okay, I guess we're ready to start. Welcome everybody to the webinar series by ABFER. This is a capital market development, China and Asia or beyond. I am Jiayin from PBCSF at Tsinghua University. And today we have speaker Professor Su Yang from CUHK, and he will be talking about empowering through courts, judicial centralization, and municipal financing in China. And Suyang, you have 25 minutes, and then we have the discussion going on. Okay, go ahead.
Okay, great. So first of all, thanks Professor Zhang and Professor Yang and all the committee members for including our paper in this wonderful session. Okay, it's a great pleasure to be here. So as Xiaoyan mentioned, the paper is titled Empowering Through Courts, Judicial Centralization and Municipal Financing in China. So this would be an empirical paper on the interaction between the judicial system and the municipal financing. So this is joint work with Jiayin from Peking University and Wenwei, who is now a postdoc at Harvard. So Wenwei will be on the market soon. Okay. So there is a classic literature on the interaction between law and finance. So the basic idea on this literature is that the judicial system or the legal environment is crucial for the enforcement of contracts. And we know financial contracts are the foundation of the financial market. So the well-functioning of the judicial system is necessary for the well-functioning of the financial market. So along this literature, there is some discussion on a very specific aspect about the functioning of the judicial system, which is the political influence over courts. So the basic idea is that the political influence over courts can signal the government lack of commitment to respect contractual obligations. So the idea is that if things were not well or in a bad state, the government may affect the court decisions so that they don't need to respect the contract obligations. Okay. So this is pretty important when we think about public finance, because this could induce like strategic government default on that. So this is a pretty serious issue in the history of the US local judicial system. Like for example, in 1858, so after the pandemic of 1857, the Supreme Court of Iowa simply wrote off all those outstanding debt of municipal cities within that region. And the reason is to respond to the wills of the local residents. Okay. So prediction of this kind of logic would be that the political influence over courts should reduce the government borrowing capacity, because at the end of the day, if I'm a lender, I cannot expect the borrower to repay. Why would I borrow or lend to him in the first place? Okay. So a lot of this discussion, if we think about it, they are all centered around those high-level courts with very substantial power, okay? And there's a lot missing along this discussion, which is that the majority of the commercial lawsuits, if you look at the data, they are actually handled by those grassroots level local courts who actually have very little power. So my question in this paper would be, how does the political capture of local courts affect municipal financing? So does the same prediction for high-level courts also apply in the case of local courts? So now let me just go straight to the very important baseline results in this paper. Okay, so I'll give more details about what's the specification, what's the shock that we have in mind. But this figure basically shows that there is a judicial reform which is designed to reduce the local court capture or the political influence over local courts. So the effect of this policy is confirmed in the first figure, the left panel. So basically, we find that after reform, there is a substantial decrease in the win rate of local government in commercial lawsuits, which basically confirms that the reform has been very effective to reduce local court favorism. Okay. So what's surprising is on the right, we see that after reform, the borrowing cost of local governments, which is made by the municipal corporate bond yield, actually increases. Okay, recall in the previous discussion, the reform should have predicted a decrease in the borrowing cost if we think about the same logic for high-level costs. So this opposite effect is really the motivation for us to write this paper, to dig into what's going on. Okay, so for now, the reason that we think the effect is not negative is really because the local courts, they have very little power in judicial interpretation, and they cannot affect the government adherence to contract obligations. That is, no matter how strong the political influence over local courts, these local courts, they have to respect the contract obligations themselves. So same kind of framework that we use for high-level courts do not apply here, okay? So now let me give a full overview of this paper and try to explain why the effect is the opposite. So first of all, for identification, we are going to explore a policy shock, which is a high-profile judicial centralization reform in China that is aimed to alleviate local court capture by local governments in China since 2014. So this reform was like implemented in a staggered way. Different cities, they have the reform in different years. So you can use like difference in difference estimation strategy to establish what's the causal effect of the reform, okay? So first of all, we confirm that in the data, the reform has been actually very successful in reducing the local court favorability towards local governments. So in this paper, we'll focus on this local government financing vehicle, which are the legal entities that the local governments will use to finance the project. So we'll look at the balance sheet, the borrowing, and also commercial lawsuits all around involving these local government financing vehicles. Okay. So first we find after reform, indeed, the LGFV's win rate in commercial lawsuits will drop significantly by about 17% when against external plaintiffs and about 11% when against the local plaintiffs. So these 70% and 11% are absolute value. It means that on average, the LGFV's win rate will decrease from about 58% to about 40% after reform. Okay. So we've done a lot of robustness tests like placebo tests, intensive margin, and ex-ante contracts just to confirm that the decrease in their win rate is indeed due to reduced court favorism. But due to the time limit, I may not go through the details of this. So the main finding or the main focus of the paper is on municipal debt capacity. So we first established a bunch of adverse effects of the reform on municipal debt capacity. So we look at the debt default, we look at the debt capacity, we look at the spending, we look at the borrowing cost. All these results show that their borrowing capacity was adversely affected by the reform. So what's going on? Why the effect is opposite on the local level? So we propose two kinds of mechanisms. The first is very straightforward, like increase the lawsuit loss. Because if the local governments lose lawsuits with other parties, they have to bear more lawsuit loss. And these will reduce their profit or their cash available to repay their debt. Okay. The second channel we want to highlight in this paper is the information protection by the court. So what do I mean? So if you look at the data, most of the lawsuits involving these LGF fees are against the counterparties, which often revolve around government payment delays. So think of that as the government has a project, it contracts with some construction company to build it. At the end of the day, the government didn't make the payment in time. So that's the main reason for all these lawsuits. So we propose that there are two motivations or reasons for government payment delays. The first would be the contractor didn't do a good job, and that's why the government don't want to pay. The second is that the government is in liquidity constraint. As a result, the government cannot make the payment. Okay, so the losing lawsuits around this kind of payment delays will predict or signal to outside investors that, well, the government probably is in liquidity constraint. That's why they cannot make the payment. The court already says that the contractors, they did a pretty good job. It's not their fault. So losing lawsuits will send a signal to outside investors about the government financial constraint or the liquidity constraint. To have direct evidence to show this mechanism, we find that if the government loses lawsuits around payment delays, this will lead to a significant effect on their credit rating downgrading in the next 1 year. And this is especially important in those less physical transparent cities. Okay, so this is basically the overview of all these results. Okay, so I'm going given the time limit, I'm going to skip the literature. I will first give you some background information to help you understand this paper. And then we'll first show that the effect has been very successful in reducing court favorism towards LGF fees, and then show all these adverse effect on LGF's debt capacity and their spending, and explain the mechanism. Okay. So the first thing that we need to know about China's judicial system is that we have a hierarchical system. So this is basically the same case as in US and other countries. So we start from the very local level and then move up to the top Supreme Court level. Okay. So what's unique about China's system is that all these local courts and the judges, they are managed by the same level of government. So basically the same level of government, they can decide the promotion and appointment of judges and also decide how much money to give for this local court to spend on an annual basis. So this has led to a lot of concerns regarding local protectionism and interference by local officials, because at the end of the day, these local officials have great leverage over local judicial system. That's why in 2014, the central government initiated a bunch of reform, which we all refer to as judicial centralization reform. This is designed to segregate the local courts and the judges from local government. The reform has two components. The first is to change the personnel management system. So after reform, the appointment and promotion of local judges and also procurators will be determined at the provincial level. And also all their income, their budgetary revenue will also come from directly from the provincial level. So after reform, basically local government will completely lose leverage over local courts. So the reform was implemented in a staggered way. So basically it started from 2014, and by the end of 2020, there's still like 1/3 of a city, which is about 100 cities that haven't initiated reform yet. So we did a bunch of research on why these cities haven't done that. A very good answer that we believe to be relevant is the provincial government fiscal capacity. Because at the end of the day, after reform, the provincial government needs to provide money for these local courts. And the court expenditure is very substantial when we compare it to the provincial government fiscal revenue. So for example, countrywide in 2014, the local court expenditure is about 4 to 5% of provincial government expenditure, with a lot of variation across different regions. So for example, if you look at Jiangsu province, which is the province that haven't done the reform yet by end of 2020, their court capture is about 6% of the provincial government budget income. So there is no way that Jiangsu province can implement a reform without additional support from the central government. Okay, so this is just a timeline about this reform in different cities. So it starts from some central area here. In the next year, in 2015, it was implemented in Guangdong province and Shanxi province, and gradually spread out over across the country. And Jiangsu is here, so by end of 2020, they haven't done reform yet. So second thing we need to know is about China's local government data system. So basically, we know in 2014, 19 and 1994, we have this budget law which prohibits local government from issuing debt. So this changed after the great financial crisis, because in 2008, we have this fiscal expansion, fiscal stimulus, and the central government just opened a back door for the local government to finance through debt obligations using these local government financing vehicles. Okay, so these LGF fees, they can finance government projects through like municipal corporate bonds, bank loans, and all those other debt obligations. So in this paper, we'll focus on all these balance sheet financing or commercial lawsuits revolving or involving these LGF fees. Okay, so now let me first show you one figure which gives you some idea like why the judicial reform is such a big deal for local governments. So in this figure, I plot the total number of lawsuits involving these LGF fees over the years. So on average, we find that the average number of lawsuits per matched LGF fee is about 33 in the data. So this is tremendously large. For a regular private firm, the number is 0.1. So LGF fees are heavily involved in these commercial lawsuits with counterparties. That's why we believe that the reform could have a big deal, a big effect on them. Okay. So for the data, we use, so most of the data are very standard. We use LGF fees financial information and the bond issuance from WIND. And we also use this is essential for the paper. We need to use all these court rulings. And this is downloaded from China Judgment Online. So this is the data that has been used by many researchers in the recent years. So we'll match all these verdicts with LGF fees, and we find about 70,000 verdicts during our sample period involving LGF fees. So for our paper, we need to calculate what's the judicial lawsuit outcome for LGR fees, which is the win rate. So by the convention of the judicial system, we can look at how the court fee is split between two parties, because in practice, the court fee is paid more by the party who lose the lawsuit. So we can just use the fraction of court fee paid by the other guy as the measure of the win rate for local governments. Okay, so this will be a continuous variable that measures the lawsuit outcome. So we also use some value-added tax involved and then supply data for the paper. But let me just skip that. Okay, so first let me now first show you like the reform has been very successful. We did a bunch of we spent quite a few time on this exercise, because if you talk to those legal scholars, they were quite suspicious about whether reform was successful at all, because at the end of the day, it's not a complete reform that ensure the independence of local courts. It is a partial centralization reform because the provincial government will still have leverage over local courts. Okay, so we want to make sure that the reform has indeed been successful in reducing the judicial favoritism towards local governments. So for these exercises, we will explore the staggered rollout of this reform during these years. So for the court to protect local governments, the lawsuit has to be handled by the court in the same city as the LGR fees. Okay, so that's why we will focus on the cases where the lawsuits, the LGR fees will be either defendants or the lawsuit is against the local defendants. So in these kind of cases, the case will be handled by the court, which is in the same city as LGR fees. Okay, so we also use cases where the case is handled by external courts as placebo test, and we do not find any effect in that part. So we also control for this heterogeneous treatment effect following the literature, and we also try a bunch of other approaches to make sure it's very robust. Okay, so this is the most important baseline result, which is the event study that we try to explore whether the reform has reduced the court favoritism towards local government. So we'll focus on two samples. The first is that the LGR fees are local defendants, and the second sample where the LGR fees are against the local plaintiffs. So as I mentioned, in this case, it will be handled by the court in the same city as the LGR fee. Okay. So we see pretty similar low difference in the change of win rate right before the reform, and right after reform, we see a substantial decrease in their win rate, which could confirm that after reform, indeed, the court reduces favoritism towards LGR fees. So this table just summarizes all these results. So on average, we find that their win rate after reform will decrease by about 14%. And there is a bunch of heterogeneity that we also explore in this paper. But for now, let me just skip them. Okay, and we also did a bunch of robustness tests and effect on the intensive margin versus the extensive margin, and also response of contracting price and contractors. So all these exercises, I will skip them, but the key message is that they confirm the effect on the win rate of LGR fees are indeed due to the reduced court favoritism, not other local shocks, and etc. Okay, so now let's talk about how the reform has affected the LGR state capacity and spending. So I want to say that there is no basically little direct effect on this LGR fees on the creditors, because in the data, over 97% of the lawsuits are against their business partners. The remaining 7% are against typically the financing companies, very few against the banks, and 0 case against the bond investors. So that's why the reform shouldn't have any direct impact on the creditors of LGR fees. Okay. So before I talk about all this causal effect, one may concern about reverse causality. So maybe the reform or the financial conditions have driven the reform in the first place, because at the end of the day, if the city conduct a reform, then I do not need to spend money or give money to local courts. This can help me to save some money. But if you look at the data, local court capture expenditure is only a tiny fraction of the city government budgetary expenditure. So this couldn't be the motivation in the first place that drives the reform across different places. And we also find that none of the key outcome variables that we are going to explain can predict the reform status. Okay. So let me now show you all these adverse effects. So the first thing we look at is LGF default risk. So basically, we find that after reform, the default rate of LGF is on those non-standard debt obligations will increase by about 0.5%. And on average in the data, the average default rate is about 0.3%. So effect on the default is also substantial. The second we look at is all those their bond issuance. So we look at their net issuance over year divided by the city's budgetary revenue in 2013, and we also look at the average yield. We see a decrease in the issuance and increase in the yield. So both predict or is consistent with the fact that with the conjecture that the demand for their bond has decreased. We also look at the LGF balance sheet. We see on average, their asset will decrease by about 10%. The borrowing cost will increase overall by about 0.3%. The only thing that increases is trade credit. So they were going to receive more trade credit from their counterparties by about 2%. Okay. So what's the mechanism? Why we find all these adverse effects on LGF fees? So the first mechanism we have in mind is increase the lawsuit loss. Okay, so very straightforward. If the local government lose these lawsuits, then of course, then I'm going to pay more for the counterparties, which leaves me with less resource to pay my creditors. But if when we look at the data, we find that the magnitude of this lawsuit loss is only about 14 million over the years, and that's about 0.1% of LGF accumulated cash paid for goods, services, investment, and etc. Okay, that's why we think this cannot be the most important mechanism. So the second mechanism we have in mind is the information production by the court. So over the years, the court rulings has been intensively used by financial analysts to gauge the financial conditions of the local governments. Okay, and when we look at the nature of these lawsuits, they are mostly around these government payment delays. As I mentioned, the government cannot make the payment or does not or choose not to make the payment. And we think there are two drivers for this kind of payment delays. The first is liquidity constraint of the LGF fees. That's why they cannot make the payment. And the second is just the misconduct of these contractors. Okay. So in this kind of scenario, for outside investor, if I observe that the court didn't support the LGF's defense for payment delay, the outside investor will believe that it's more likely that the payment delay is due to the liquidity constraint of the LGFs, rather than the misconduct of contract. As I perceive the LGF is more likely to be liquidity constrained, I would cut lending to them, and the difficulty in roll over the debt will accelerate or increase the debt default over LGFs. Okay, so to provide direct evidence on this, we'll test the following conjecture, which is losing lawsuits around payment delays can lead to credit rating downgrading. Okay, so to test this hypothesis, we'll focus on all these samples where the LGF has lost at least one lawsuit with their payment delays in a certain year. And then we examine whether the average win rate of these cases can predict the probability of rating downgrading in the next 1 year. Okay, so we first done OS regression and indeed find a very negative effect. If they lose the lawsuit, their rating will be more likely to be downgraded. So also conduct an IV estimation. We just instrument this win rate with the judicial reform. So this means, or these IV estimates means that changes in win rates induced by the reform, holding information collection from all the other sources constant, can affect the credit rating downgrade. So this is strong prediction or evidence for the conjecture that indeed, when the government loses the lawsuit, especially around payment delays, all the outside investors will likely to downgrade their credit rating. So as placebo test, we find that there is no such effect on other kind of cases which does not involve government payment delays, because this kind of case is a lot informative about the government liquidity constraint. Okay, so if you look at the magnitude, it means that the reform could increase their rating downgrading by about 2%, and in the data, average is only 2%. So as additional test for this hypothesis, we find that the effect is more important in less fiscal transparent cities. Okay, basically in these kind of cities, if they disclose less information, then the information protection by the court should be more important. So in the data, we'll try two measures for the fiscal transparency of the cities. The first is the fraction of bonds issued with a rating, and the second is the City Government Fiscal Transparency Index, which is developed by the Center of Public Economics, Finance, and Government Research in Tsinghua University. So for both measures, we find that the effect is more pronounced in low transparent cities. And in high transparent cities, the effect is negative, but much smaller in magnitude. Okay. So I think I'm about to time, but let me just spend the last minute on this, why the reform affect the, why the reform could need to, how does the court information production reform rule explain the effect of the reform? So basically, the reform can allocate more LGFVs from the lawsuit winning to lawsuit losing group. As from outside perspective, after I observe that the news, I believe they are liquidity constrained, then I tighten credit condition to this marginal affected LGFVs. So I want to highlight that this reform does not necessarily predict better information production, because at the end of the day, these marginal affected LGFVs, they can be both good and bad in terms of credit risk. So this is conceptually different from information production that improved information production and reduced information asymmetry. Okay, so unfortunately, the reform does not improve the information production from this perspective. So I also done a bunch of robust check on the real impact of this reform. So and I'm happy to discuss it during the QA, given the time is up. Okay, so this is the conclusion. Thanks all, and I looking forward to discussion. Thanks from Jacopo.
All right, thank you. Very, very precise timing. Okay, now let's welcome Discussant Professor Jacopo Ponticelli from Northwestern. 25 minutes.
All right, great. So first of all, let me check if you guys can hear me and can see the slides.
Yes, yes.
Yep.
You need to make it a full
All
screen.
right. Yeah, should be full screen now. All right, great. So first of all, okay, so that thanks to the organizers for asking me to discuss this paper. As I was mentioning before we started, I a few years ago presented a paper of mine in this seminar, received a lot of comments, a lot of questions, and it was very useful for us to revise the paper. So I hope again I can help the authors here a little bit tonight. So Yang did a great job. So let me just very quickly summarize the paper. What they study is this big question, which is what is the impact of judicial independence on local government debt financing? You have heard sort of the setting is China, and the key variation here is going to come from this 2013 judicial reform that was introduced in a staggered fashion between 2014 and 2020. And the key of this reform is that it transfers decisions about the local judiciary from the municipal government to the provincial government. Okay, so when it comes to decisions about budget, about how many judges to hire, who to hire, these decisions are now moved one level up. And so they think of these as a shock to the independence of local courts. They have a lot of results. And so, let me just, there are sort of basically three blocks that I want to emphasize. The first are the results about the judiciary. And this is what Yang has showed you. The win rate of local government financing vehicles decline after the introduction of the reform in a given city. This means, when these local government financing vehicles are brought to court, for example, by suppliers for a missed payment, now they are less likely to win after the reform. When we look at the bond market, when they look at the bond market, that's where there is maybe the most surprising result. What they find is this decline in net issuance, which is very large, 10 to 15%, and an increase in yields. Okay, so this is sort of counterintuitive, prima facie at least, so I'm going to spend a little bit of time thinking about that. And then sort of there are these very important large real effects. Okay, so this reduction in debt capacity has a negative impact on the value of the assets of LGFVs. There's a large decline in spending, and Yang didn't have time to go through this, but they document also this decline in developed land quantity and price. Okay, I have sort of three broad comments. So the first set of comments is going to be about the contribution of this paper to the literature. Then I think it's important to talk about mechanisms here, especially because they have these counterintuitive results. And then I have some comments on the empirics that hopefully are helpful. So first of all, let me start by saying that I'm very biased here. I really think this is a super important topic. As Yang said at the beginning, there is whole literature showing that a well-functioning judiciary, it's a pillar for having well-functioning institutions and markets. I guess the question that also interested me for a long time is what does it mean to have a well-functioning judiciary, and what are the main frictions in the judicial system, especially in emerging markets. And I think what makes a judiciary well-functioning is that it has to be efficient, so it has to be, relatively fast in coming up with decisions. It has to be specialized, so especially when it comes to debt contracts, you need judges that understand debt contracts, that understand covenants, that understand interest rates, that understand bankruptcy procedures, and it's got to be independent, right? So it cannot, cannot be a judiciary whose decisions depend on the will of local politicians or central politicians. Now, the first two aspects have received a lot of attention in the literature. And if anything, is this third aspect of independence has received less attention. So I'm very happy to see this paper and others in recent years sort of focusing on this specific aspect. But the general implication for credit markets here is really that if you can reform your judiciary and make it such that that judiciary facilitates a speedy and fair repossession by creditors or payment to suppliers ex post, I mean, that should lower borrowing costs for debtors ex ante. Okay, so that's sort of standard, like sort of basic economics on who pays the cost of financial distress ex post, and the larger those costs are, the larger is going to be the interest rate charged on borrowers ex ante. Okay, that's what we teach PhD, what we teach MBAs, that's sort of basic economics, right? And if you look at the cross-country data, there's a lot of evidence that seems consistent with that basic idea. The graph on the left here shows you one dimension of a well-functioning judiciary, which is how long it takes to close a bankruptcy case. So the horizontal axis here captures time in court for a bankruptcy case. The vertical axis captures recovery rate, meaning how much I can hope to recover if I'm a bank and I'm trying to recover, $1 from a firm in court. What you see is that the longer it takes, the lower the recovery rate is, right? The more inefficient judiciaries lead to lower recovery rate. And the graph on the right tells you that lower recovery rate tends to be associated with higher interest rates. Okay, so it's sort of the mechanism we were discussing before. Now, all this, this evidence, of course, is about firms, but, the same reasoning should apply when the government is the borrower, right? So if you have a government that strategically default by, for example, using its influence on courts, then that government will likely face higher interest rate that undermine its borrowing capacity. We have a ton of sort of anecdotal evidence on serial defaulters across history. The guy here on the left is Philip II of Spain that defaulted 4 times during his reign, and it's often, to spend on wars across Europe and fancy clothing, as you can see here from the drawing. And on the right here is Argentina, which we often bring up as an example of a serial defaulter nation, and has defaulted 5 times just in the last 40 years. As Yang has mentioned, there is also evidence in the literature of this channel at subnational level. So there's this paper by Dove, 2018, Journal of Comparative Economics, that looks at what happens to bond yields when state courts of last resort, basically constitutional courts in the US, become more or less independent. And so, this study is about the US in the 19th century, but what it finds is that sort of higher independence here seem to have led to lower bond yields, which is sort of consistent with sort of this broad picture I said before, this basic economic mechanism I outlined before. I also want to mention how focusing on local courts and payment to suppliers is a really big deal, and it's a really important deal. It has been at the forefront of also in the European Union. What I'm showing you here is an article from 2017 in which the European Commission basically brought Italy to the Court of Justice to Europe because they were failing to ensure suppliers' payment on time. The European Commission has pretty strict rules that you should pay suppliers as a local government within 30 days, local or central government within 30 days, and Italy average was above 100 days. So this was a big deal. They brought the course to Europe, to the European Court of Justice, and that has pushed sort of some changes in Italy in that to shorten those payment times. Now, so the paper contribution to the literature here really is to document this surprising finding that when you make these local courts more efficient, what you actually have is an increase in yields and lower debt capacity. Okay, so there's sort of this sort of counterintuitive results. And as Yang mentioned, of course, the question is why. And as Yang mentioned, in the paper, they underline this fact that there are many differences between high-level courts and low-level courts, and we know not so much about these low-level courts. But if I think about it, I would imagine that the economics are not the difference between high level and low level. So there has to be something about the mechanism here that we need to understand. And so let me make a couple of comments on the mechanism, and let's see if that can be helpful. So there are basically two mechanisms here in the paper, right? And the first one basically says, look, when you make the judiciary more independent, that will lead to higher expenditure for local governments, more costs. Why? Well, because they have to pay suppliers. They lose the case in court. They were delaying their payment. The court rules that they have to pay. Well, this money's got to come out from the budget, and they have to pay suppliers. Here, I mean, I want to underline that if contracts work, this payment to supplier should not be a surprise. That's exactly what you expect from the contract. It's not an unexpected shock. And so the question is, isn't it reassuring for prospective creditors or suppliers that the government is, that the local court is imposing the rule of law on local governments? My intuition would be that this has to be reassuring for them, and therefore that should increase actually the demand for bonds. However, I think there is an implicit assumption in the paper that is maybe true in the data as well, and that's what I want to push sort of the authors to investigate this a little bit, or at least make it explicit. I think there is some assumption here about selective default. I think, you know, in the background, there is this assumption that if the government saves money by not paying suppliers, it has more money to pay bondholders, and this money is available to bondholders. The government will default on suppliers, but will never default on bondholders. That is a very strong assumption, and maybe it's also true in the data, but you need that type of selective default in the background to have this mechanism at work. Otherwise, an increase in expenditure because of a contract that the local government has signed, that's not an unexpected cost shock. That's just, you know, the court ruling what the contract says, right? It's just rule of law. There's this second mechanism that I find very interesting, which is the fact that investors can actually learn something about the credit risk of local governments because of this, when these cases go to court, okay? And the question here for me was, I really wanted to know more about what is the exact information that gets revealed in these cases, and you know, why the investors don't have access to this information outside of courts, right? And again, I think here in this mechanism, there is another implicit assumption that I would encourage the authors to sort of make even more explicit in the paper. It seems that the authors have a very sort of specific model of the world here, which is the following. There are different types of local governments. Some are liquidity constraints and some are not. And these different types of local governments use courts differently, okay? So if I'm a non-liquidity constrained local government, I will bring a case to court. I will go to court only if the contract is violated by the supplier. Not only if the supplier doesn't deliver the goods or doesn't deliver the services, then if I have the money, you know, I will pay the supplier if, you know, if the goods have been delivered. But if they have not been delivered, then I will bring it to court. And if that's the case, you know, I will always win, right? Because I'm right. The supplier has violated the contract. Then there is another type of local government, which is a liquidity constrained local government. And that local government will try to strategically default by influencing local courts. Why? Because that government doesn't have the money. And so, you know, no matter whether the supplier has delivered the goods or not, that type of local government will strategically default by delaying payments through its influence on local courts. Now, the interesting thing, if you believe this model of the world, is that before the reform, you know, you have influence on courts, you do this strategic default, you win in court, and you delay payment. But after the reform, you lose your grip on local courts and you start losing. So if this is the model, the true model of the world, then I agree with the authors. After the reform, if you lose in court, that's a signal that you're liquidity constrained. However, again, I want to emphasize this is only true if what I just described is the correct model of the world. And, you know, maybe it is, maybe it isn't. I don't know, but certainly, you know, it's hard to read a loss in court as a signal of liquidity constraint without building a little bit of this sort of assumption in the background. So my push here would be for the authors to be very explicit about what are the assumptions they're making, even write down a simple model if you want, but more importantly, convince the audience and the reader that these assumptions are correct in the data, right? When it comes to mechanism, I feel like there is also a lot of, throughout the paper, a lot of mentions to the fact that these local courts don't really have a lot of power. They have to respect contract terms. They cannot really cancel debt obligations. And I felt like, I'm not sure how much you want to emphasize this point, in the sense that if that's the case, if there is very little wiggle room for local courts, then it's hard to think that reducing the influence by local politicians can have these massive effects on real outcomes, right? You really document very large effects. And so these large effects are unlikely to happen if these local courts are sort of, unable to swing cases in an important way in favor of local government. So here, I would push the author really to clarify how does this political influence facilitate default in the pre-reform period, and if there is any way to ascertain whether there is pro-government bias in rulings, that would be great, like, for example, violations of the letter of the contract to benefit the government. But more generally, I think my point here is that I find the argument that the local courts cannot do much as something that is a little bit, there's a tension between that and the large effects that you document when this independence is enforced at local level. Okay, sort of the last part of my discussion, I want to talk a little bit about the empirics. And I think this is a very nice natural experiment. So let me start by saying, I think the paper is, it's like the state-of-the-art diff-in-diff type of paper. It's very careful in describing, this staggered introduction of the reform in different areas. It is a great reform because it is introduced in different years in different cities, and there are some cities in which it is never introduced. So you have a group of never treated cities that you can use as like a pure control, and that's actually pretty good. I think that the paper needs to engage a little bit more on the key concern that the reader is going to have, which is what drives selection into treatment versus control here, right? There is some discussion of it, but I think you need to push this a little bit more. Let me make an example. Like the paper shows sort of a comparison of treated and control. When I say treated, I mean cities that implement reform and cities that do not, and compared in terms of their characteristics at baseline, the level of their characteristics at baseline. But I think it's important also to compare them in terms of growth rates in those characteristics, especially fiscal variables in the pre-reform period. Are there any trends that explain whether I enter into the reform earlier or later? And also, it would be ideal to have sort of some description of potential confounders and control for exposure to potential confounders. Potential confounders are other reforms that happen at the same time and will push the outcomes in the same direction, but are not this one, right? And with exposure sort of correlated with exposure of your reform. And I think you have to fight a little bit this battle, exactly because, as you said, there is also some skepticism from the institutional side that this reform was actually so important in generating sort of this independence. And so it's very important that you engage with this criticism. And I want to emphasize this point because your magnitudes are very large, right? So the magnitudes indicates that this reform generates a large negative shock. And this could be just this reform or the cumulative effect of multiple shocks, but you find, significant effects on debt downgrade. The net issuance of these municipal corporate bonds declined between 10 and 15%. That's a massive effect. The assets of LGFE declined by 9% in the treatment relative to the control. Local government spending declines by 20% in the treatment relative to the control. So this is a large negative shock. So let me tell you, like, potential confounders that would be worrisome are sort of dynamic confounders, like stuff that happens at the same time and with the same timing and affecting the treatment more than the control. And I think this period is interesting because there is a lot of other policies that sort of push to lower or contain subnational debt. And so you want to engage with that. And I'm going to make a couple of examples, and I'm really not an expert on this, but I think you guys that know more than me about this, you probably want to think about it. One is, the 2014 revision of the budget law. de-emphasize more transparency, disclosure of existing debt. So it's also sort of authorize local governments to borrow directly via bonds. And you talk a little bit about this reform, but I think you need to engage a little bit more on whether this reform was likely to affect treated versus control cities in a different way. There's this 2014 State Council document 43, which is about trying to limit borrowing by LGFV. And more generally, I mean, the financial regulators in this period, I think, are pretty worried about subnational debt and trying to curb it in different ways. And so when I see this massive decline in net issuance, in the back of my mind, I'm thinking maybe some of these other reforms sort of hit these cities in the same period at the same time, right? So that would be my worry. I have another comment about the empirics that is more sort of, and it's about the timing of the effect. And I commend the authors for being incredibly transparent, like for every outcome, they report it in tables, they do robustness, they show event studies. So this is like kudos to the authors. I think this is like really what an empirical paper should do. And so that's great. One thing, of course, you expose yourself to, you're very transparent about all these outcomes. So, some stories, some potential concerns come to mind. And one is sort of, what is the causal chain of events here, right? So the causal chain of events in my mind is that you have this increase in independence that lowers the debt capacity of local governments. And then that leads to a lower ability to invest and spend, right? The government has less money available, they will invest less, spend less. But if you look at the timing, it looks like debt issuance sort of start declining significantly about 3 years after the reform. But the real effects on investment and developed land area, for example, those start to materialize a little bit earlier. Already in year 1 after the reform, there are some significant effects which are pretty large. These are large coefficients. And you can see sort of just by looking at this graph versus this graph, in my mind, net issuance should decline first and then investment, or at least at the same time. And here it looks like the real effects start to arrive a little bit earlier than the net issuance. And so that worried me a little bit. I have another, last comments on the empirics that is about like how you aggregate the data. The paper basically aggregates all bonds issued by in a certain city and year. Here, I would suggest an alternative approach, which is to use bond level variation in pricing over time. So you're, for the same bond, controlling for bond and issuer fixed effects, or controlling for time invariant stuff, what happens to pricing of these bonds around the shock. I think that would be, you have the data to do it because you have the data at the bond issuer level. So I think that would be nice. And I think that would also deal with potential concerns about composition effects, because now, the issuance declined substantially. So the composition of bonds that are part of your outcome changes over time. And so you cannot really control for sort of, these bond characteristics that are time invariant, and just look at how trading of that bond affects its prices, right? So that's just a suggestion. Okay, so let me conclude there. Let me say, first of all, I think this is commend the authors. This is a really important research question. I think there's a lot of interest in this, not just in China, but in the US, in Europe. This paper is, maybe early stage, but has great potential. My nudge to the authors are, you have this important contribution. It's counterintuitive. I think you embrace it pretty well tonight in the presentation. Maybe in the paper is a little bit more prudent, but I think this is, it's important to be upfront about it, and I think you are. I would try to clarify these mechanisms. I think the mechanisms are potentially plausible, but there are some assumptions behind, as I said before, and so you need to be upfront about what are the assumptions, what is your view of the world in which these assumptions are true, and so you need these assumptions for the mechanisms to be at work. So you want to be very upfront about that, and ideally show the reader that these assumptions are true in the data. And finally, I would try to discuss these dynamic confounders and this timing issue. But I look forward to read the new version, and I think this is a great agenda. So and thanks a lot for inviting me to read this paper and discuss it.
All right, thank you, Jacopo. Now I'm gonna open the floor for questions, comments, and so on and so forth. Before I do that, I do have an announcement to make. Our next webinar is going to be on October 17th, and the topic will be, does open banking expand credit access? And the presenter will be Palak Ghosh. Okay, all right, now if you guys have questions, Michael, go ahead.
Yeah, so Yang's presentation shows extremely interesting results, and I'm also very impressed by fantastic discussions made by Jacob. I want to follow up on one of Jacob's comments on what's the true sort of model, a true story of this counterintuitive result. Let me just propose one possibility. So think about the law experts and political scientists. So when they think about this judicial system reform in China, they sort of, some of them proposing like dual state. One is a normative state, and the other is what they call the prerogative state. So a lot of reforms you see are actually in normative state, like, the bankruptcy law, a bankruptcy system, Jacob and both studied before. But when it comes to local government debt, then immediate question is whether or not that's in a normative state or in a prerogative state. If you think about the prerogative state, then the first order thing is to try to keep sort of maintenance and stability of the economy. And that requires some kind of support from the central government to deal with those troubles created by local governments. Then if you push this line, then what does it mean if a local government loses a lawsuit? So it means one signal that we may learn, investors may learn from that is not just that the local government is liquidity constrained, as Jacob said. It's also possible, it's a signal that this local government is losing its political support, or losing favoritism from whatever high. You can think about provincial government, you can think about the central government. So then it's kind of quite intuitive to see why the market would like to respond in this way, and I didn't see Yang presented the set of results that Jacob showed us towards the end of his discussion. Like investment also responded. If I understand this correctly, that seems pretty in line with the local government's this local government basically loses some kind of support from the up-level government. So this is something I would encourage Yang to think about. Thank you.
Okay, Yang, do you want to respond or anything?
Oh yeah. So for Michael's comment, I think that's pretty relevant. So especially given the magnitude of this effect, we're also thinking about what are the potential alternative mechanisms. What Michael just mentioned, like the losing the lawsuit can also signal a loss of support from the up-level government. That sounds quite plausible. So we'll dig into that. Okay. So Jacopo, you mentioned a lot of things. So let me respond to a little bit of that.
So yeah. Why don't you wait for all the questions being asked?
Oh, sure.
And then you address the discussion. Bernie, do you have a question?
Yeah, I need some clarification. First, I want to thank Yang Shu and also Jacopo. Really wonderful presentation and discussions. Helps me a lot to understand the issues. In my mind, there are two, as I understand it, there are two kinds of lawsuit. One is with the suppliers. The other one is with the lenders. So I'm the government, and so I engage in the lawsuit. The two are of different nature. So my seeking of clarification is how can we decompose the impact of these two? Dealing with suppliers very often could be a revelation of a fiscal situation. Somehow I just cannot pay. In Chinese term, 我老赖, okay, or in American term, it's like I just drag on. Then in the debt case is a different thing. And so, yes, there is really indeed a cleaner case, change the allocation of rights towards the supplier or towards the borrower or towards the lender. And the two would have very different implication. In the first kind, it would be really about the fiscal situation, the fiscal capability, et cetera, et cetera. The second kind is really about creditors' right. And your counterintuitive result seems to stem from the first kind, not the second kind. So I wonder if you can clarify this to help us to understand better the result of your paper. The second thing I have in mind is about the endogeneity of the adoption. It would be much better if you can give us, maybe in the paper, I should read the paper more carefully, but if you can give us a better reading on the choice in adopting the reform, because it's up to the provincial government to adopt this. So what are the conditions? Why do they do that? Why do they not do that? I think it would be very helpful. And then also it will nullify my concern if you clarify that on that your DID is not exogenous and is not dealing with endogeneity issue well enough. So it would be helpful to clarify that.
Yeah, so shall I respond?
You respond to Bernie before you respond to your discussant.
Okay, so thanks, Tony, for the two questions. So the first thing I want to say that in the data, we do not find a lot of cases for the second type. So the direct lawsuits between creditors and LGFs are very few in the data. So about 93% of the cases are with suppliers. And for the remaining 7%, so some of them are with those normal like individuals, like the government or the LGF build some public housing and etc. And they cannot deliver it and etc. So there will be also lawsuits with these individuals. So very few with those financing companies. And we didn't find only 1 or 2 cases with banks, but 0 with bond investors. So that's why we think that.
So if that is the case, your result is really about allocating more property rights to the suppliers. And that's why you have the result. It's not allocating more property rights to the creditors.
Yeah, in some sense, it's like, if we think about the first mechanism, it's about you give more to the suppliers, which leaves you with less for the creditors. Yeah.
Then maybe it's better to just explicitly admit that and get rid of all the creditor cases.
Yeah.
And it's easier for us to understand your paper.
Yeah. Okay, I just want to be transparent, like in the data, what do we serve, right? So majority of the cases are actually involved with suppliers, very few. So for the second question, like why certain cities, they try to adopt this reform. So we read a lot of papers or discussions by those legal scholars. So the only thing that we find convincing is that the provincial government, they don't have the money. Okay, so after the reform, the provincial government needs to spend money to help support these local courts. So if you look at the local court expenditure as a fraction of the provincial level fiscal revenue, in certain provinces, it's very high. Like in Jiangsu, it's about 60%. So that's why you think
Jiangsu. May I interrupt you here? Sorry. If the decision is not about the local city government's LGFV, but it also involves about raising the property right of the suppliers to stimulate growth, then it's a very different ballgame in interpreting your results in a holistic manner.
All right. So you want to respond, or can I ask my question now? I have a question about this the big macro background of this. This is about the court centralization. When they roll out the reform, there must be a policy goal when they do that. And then so if you look from the central, and then you look at the results of the judicial system as well as the local government, would you say that we're somehow achieving the policy goals or not?
I think so. So I think a lot of paper that answers this question better is by Marcosa and Shauda and Ernest Liu. So they basically find that after the reform, the lawsuit between external and local counterparties will be more there will be more justice, or more equally treated by the local courts. So that's basically the key message of their paper. I think that's the primary goal of this policy, which is to reduce local protectionism. So I think our paper on this, on the effect on public finance, is somewhat unintended, because we don't find any discussion from the Beijing and etc. saying that's part of the goal.
Well, thank you. And then I agree with your discussant. You probably want to give a little bit of this discussion and then clarify or carve out your own contribution. Now you can respond.
Yes.
Do you want to say anything about Jacob's?
Yeah. Okay. Thanks, Jacopo, for this very detailed discussion. So let me just pick a few to respond. So for the mechanism, I agree that effect is like very large. So I was also surprised to find such a big effect. So effect is not on every dimension, right? Not just on the real impact. It's also large on their default, their borrowing cost, their reduction in bond issuance, etc. So all these effects are very large. And I think one of the reasons for this large effect could be, as Michael mentioned, there with other confounding factors, like they lose support from the up level. And the second thing I want to say is that it's very large. It could be because, like in the data, there are lots so few like LGF fees that actually default. Okay, now LGF fees, if they default, like it's very huge damage to the reputation. So if they ever default, like the outside investor could immediately cut lending to them. It's because the information disclosure by LGF used to be very opaque before. So not so much way that you can get information about their financial conditions, etc. And then the single information production by the court can have a major impact, as we mentioned, especially in those like fiscal opaque cities. And the second thing I want to say could be because all these confounding, dynamic confounding forces, as we mentioned. Indeed, like if the LGF lose or their credit constraint become tightened, they invest less in those NAND. And this could also accelerate their financial conditions because now if you sell more less NAND, that leads to less revenue or less support or less revenue from direct NAND sale, which further accelerates their fiscal conditions. So all these dynamic forces could reinforce each other to make this effect so huge at the end. But I agree that we should dig into more and do some maybe back-end envelope calculation to see whether this mechanism can explain the magnitude of the effect. And yeah, for the empirics, we'll dig in more into that about all these confounding factors. So for the information production, you ask about more like explicit assumptions that we make about the world. So I think I was actually pretty excited about the table that I presented, which is the effect on the downgrading, especially like the effect is more pronounced in less transparent cities. And that's my way of thinking of this world. Maybe we can like provide some anecdotal evidence, show some typical cases of these lawsuits, like so we have better idea like what investor can learn from these kind of things. I think maybe that will be helpful, but we'll do more on that. And for the contribution, yeah, we'll write beta, I guess. I kind of see your point, which is like the real functioning of the judicial system. People may care more about the efficiency and like other kind of dimensions, but this political influence of the local courts, that's indeed less studied. When we search the literature, the paper by Dove is the only one we find with solid evidence. Yeah, we try to think about motivation along that line.
All right. Any other questions? Well, if not, I think one question already addressed by the co-author. So thank you, everybody. Today we have a very interesting paper. I especially want to thank you, Jacopo, for the very insightful and careful discussion. And we'll see you all again in October. Thank you. And this is the end of the webinar. Thanks. Bye.
Thank you.
Thank you very much. Really
Thanks,
enjoyed
Jacopo.
this.
Thank you.
Learned a lot. Thank you.
Thank you, guys. Thank you so much.
Bye.
Bye.
Bye-bye.